Hello, friends. If you have money sitting in a bank account right now, money you earned, money you saved, money you depend on, I need you to hear this. You walk into a branch you have used for years, same teller, same lobby. You ask for your own money, a withdrawal you planned. The teller types something, looks at the screen, looks back at you. She says she cannot process this today. No explanation. She hands you a number to call. You call it. Just like that money you put away over 40 years of working is locked. No court, no crime, no warning. Here is what makes this hard to fight. It is not a mistake. It is a federal rule working exactly as designed. Right now in 2026, there are 4 separate legal mechanisms that give financial institutions the authority to block access to your own money without your permission, without a judge's signature, and in some cases for weeks. Today we go through all 4, what triggers each one, how long each hold can last, and the specific steps you can take right now to make sure none of them catch you off guard. One of the 4, the last one, is the one most people find hardest to believe, because the people it has hit hardest were not doing anything wrong. Their money was entirely legitimate, and it still triggered a federal investigation. Quick context before we go further. The day. Retirees and near retirees 65 and older who hold brokerage accounts, retirement accounts, savings accounts, or who handle cash regularly. The goal is to walk you through 4 specific legal rules in plain language so you understand them before you run into them. Everything here comes from publicly available official sources: FINRA, the Financial Industry Regulatory Authority, the Bank Secrecy Act and FinCEN, the Financial Crimes Enforcement Network, the IRS, and the Office of the Comptroller of the Currency. This is educational content only, not personalized legal or financial advice. And nothing here is a promise about what will or will not happen to your specific account. Before any major decision about your accounts, talk to a licensed attorney or financial professional who knows your full picture. If you are not subscribed, subscribe right now and turn on the bell. Banking rules affecting seniors change regularly, and your institution will not explain those changes personally. Before we get into all 4, one question. Have you ever had a teller question you about why you needed your own money, asked you to wait, asked who it was for, or told you to come back another day? Tell me in the comments. Number 4. Major banks have been converting branches to what they call cash-light, or appointment-required formats. In these locations, walk-in access to large cash withdrawals no longer exists. If you need more than roughly $3,000 to $5,000 in cash, you may be told to schedule an appointment several days in advance or accept a cashier's check instead. This is not illegal, but for anyone who depends on cash or needs money urgently, this has caught people completely off guard. ATM daily limits typically run between $500 and $1,000 per day. That does not solve a $4,000 need by tomorrow morning. Pause this and write it down. Call your branch this week and ask whether they require advance notice for large cash withdrawals. Start planning cash withdrawals several days ahead as a habit. And keep an account at more than one institution, a credit union, a backup bank. So if one location cannot meet your needs, you have an alternative. Number 2 directly affects your retirement account or brokerage account. And most people with those accounts have never heard of this rule. It is called FINRA Rule 2165, published by FINRA, the Financial Industry Regulatory Authority. Here is what it says if your investment firm reasonably believes financial exploitation of your account has occurred, is occurring, or is about to be attempted. They can place a temporary hold on disbursements. No proof required. No court order. A reasonable belief is enough. Here is what that can look like. You call your broker to move $15,000 from your IRA. The transaction is larger than your usual pattern. The firm places a hold. You call back 2 days later. The word investigation comes up. You still do not know how long this lasts because the answer is not 3 days. Here is the critical detail most versions of this story leave out. The initial hold runs up to 15 business days, but under amendments confirmed by the Financial Industry Regulatory Authority, that hold is extendable to 25 business days with internal review, and to 55 business days if the matter is reported to a state authority. That is nearly 3 calendar months. And in January 2026, FINRA proposed a new Rule 2166, a 5-day hold that would apply to investors of any age, not just seniors. These rules are active and expanding. What triggers a hold most reliably? Large transactions outside your usual pattern, transfers to new recipients not in your payment history, and any interaction where you appear anxious or rushed. Pause this and write it down. Add a trusted contact to your brokerage account today. This is a person your firm can call to verify that you are safe and that a transaction is intentional. They have zero access to your money. They cannot make transactions or view balances. One of the main reasons holds extend to 55 days is that the firm cannot reach anyone in time. A trusted contact cuts that entirely. Before any large transaction, you also call the firm first, saying you are planning a specific move on a specific date creates a record that reduces the chance of a hold. Before we move on, how many of you have a savings account, an emergency fund, a safety net that you set up years ago and genuinely never touch? Drop set it and forget it in the comments right now. Number 3 applies to everyone in that situation. Number 3 is the quiet one. Under state law, a bank account with no owner-initiated activity for a set period of time is legally classified as dormant, according to the Office of the Comptroller of the Currency. Bank accounts are generally considered abandoned after 3 to 5 years of no customer-initiated activity, with the exact window set by state law. Once an account reaches that threshold, the institution must transfer the funds to the state treasurer as unclaimed property, a process called Escheatment. The funds can be recovered through your state's unclaimed property office, but that takes documentation and time. The definition of qualifying activity has also narrowed automatic transactions interest crediting, dividend deposits. Scheduled transfers may no longer count. Only a transaction you initiate manually keeps the clock reset. Pause this and write it down. Log into every account you have not touched in the past year. Make one manual transaction on each. And set an annual reminder right now, once per year, per account, that protects every safety net account you have. Before number 1, let me tell you about Carolyn, an illustrative composite representing documented patterns in structuring and civil asset forfeiture cases. Carolyn is 66, a retired nurse from Michigan. For years, she withdrew cash in amounts that felt manageable, never $10,000 at a time. Smaller amounts more often. She was not concealing anything. The money was entirely legitimate. Her bank's automated system flagged the pattern. Her accounts were frozen pending a federal investigation. Recovering access required a lawyer and months of paperwork. Cases like Carolyn's legitimate funds, a pattern of sub-threshold withdrawals, have been documented by the Department of Justice and the IRS. The law that made it possible has been on the books since 1970. Number 1. Pay close attention here. This is the rule most people argue about in comment sections, and almost no one in those arguments has it right. Under the Bank Secrecy Act, administered by FinCEN, the Financial Crimes Enforcement Network banks are required to file a currency transaction report with the federal government for any cash transaction of $10,000 or more. Most people have heard some version of this. What Carolyn's situation illustrates, and what almost nobody knows, is what happens when you deliberately break a large cash transaction into smaller pieces to stay below that threshold, withdrawing $9,500 instead of $10,000, making 3 deposits of $3,000 instead of 1 deposit of $9,000. Deliberately breaking a large cash transaction into smaller ones to avoid triggering that currency transaction report is a federal crime called structuring. It is codified in the Bank Secrecy Act and enforced by the IRS and the Department of Justice. And here is the part that sends comment sections into disbelief. The crime is the intent to avoid the report, not the source of the funds. If the money is entirely legitimate and you structured transactions to stay under $10,000 to avoid the currency transaction report, you have committed a federal crime under the Bank Secrecy Act. Civil asset forfeiture. The government seizing those funds has been documented in structuring cases where no underlying fraud was found. Not criminals. People like Carolyn who thought they were being practical. Pause this and write down what I am about to say. If you need to make a large cash transaction, make it as one single transaction for the full amount. The bank will file a currency transaction report that is completely normal and does not mean you are under investigation. What creates the federal problem is deliberately breaking the transaction into smaller pieces to avoid that report. If you have any uncertainty about whether past transactions could be interpreted as structuring, speak with a financial attorney or tax professional before making additional transactions. Here is what all 4 rules have in common. Every one was originally written as a protection. FINRA Rule 2165 exists because exploitation of seniors costs billions every year. Escheatment laws exist because unclaimed funds in inactive accounts serve no one. The Bank Secrecy Act structuring rules exist because large cash flows are the primary vehicle for moving illegal money. The protection becomes a problem when you do not know the rule exists. A commenter on the video that inspired this one wrote that her mother's bank saved the family from losing even more to scammers. The bank blocked one withdrawal and called in time. These rules work, but the same rule that saved that mother froze Carolyn's account for months. Knowing what triggers them and how to prevent a hold before it starts, that is exactly what this video was built to give you. One more question for the comments. Did you know about the structuring rule before today? Drop new to me or already new below. Let us run through all 4 one more time. Number 4. Major branches are converting to cash-light formats. Know your branch policy now and keep a backup banking relationship. Number 3. Per the Office of the Comptroller of the Currency. Savings accounts with no owner-initiated activity for 3 to 5 years can be transferred to the state as unclaimed property. 1 manual transaction per year resets the clock. Number 2, under FINRA Rule 2165, published by the Financial Industry Regulatory Authority, brokerage and investment firms can hold disbursements from accounts of adults 65 and older for up to 15 business days. Extendable to 55. A trusted contact is the fastest prevention. Number 1, structuring. Deliberately breaking cash transactions into smaller amounts to avoid the currency transaction report is a federal crime under the Bank Secrecy Act, regardless of whether the funds are legitimate. Make large cash transactions as a single full amount. 3 things you can do today. 3, call your branch and ask about their cash withdrawal policy. 2, log into every account you have not touched recently. Make 1 manual transaction on each, and set the annual reminder. Now, if the dormancy window closes first, recovery takes months. 1, add a trusted contact to your brokerage account. Call the firm today. Ask how. And get it done before your next transaction. If you work with a financial advisor, put it on the agenda. If you have a parent, a spouse, or a sibling who keeps an emergency savings account they almost never touch, share this video with them directly right now. Before you close it, the dormant account rule and the structuring rule are the 2 that arrive without any warning. Sharing this takes 10 seconds. If you want to review the structuring rule, it starts around the 9-minute 30 mark. The intent element is easy to miss on a first pass, and it is worth going back to. In the next video, there is 1 written document you can file with your brokerage today that sets legally binding instructions for how your account should be handled if a hold is ever placed. Most people with retirement accounts have never heard of it. That is coming up next.